Hello, this is Collar of Sublime Trading. In this episode of Mentoring Mondays, we're going to cover how to create a solid trading plan. Defining all of the rules we need to apply to a trading plan is a lot to get through here, but we will cover some of the most important points that your trading plan must include. They are how to enter and exit a trade, how much risk you should place on a trade, and what to do in the case where you experience a large drawdown on your account. We will cover entries first, and this depends on the type of trader you are and the strategy you are using. A day trading entry signal will differ from a trend trading one. Day traders may use indicators such as moving average crossovers or something like an RSI indicator to trigger them into a trade. Trend trading mainly uses breakout systems. If you're using breakouts, make it clear if you want to enter straight after price breaks out of a support or resistance level, or whether you want to wait for a break and close of a support and resistance level. The choice is yours, and there's not a right or wrong way of doing it, so it's best to choose a method which you feel comfortable with. Here at Sublime Trading, we enter breakout trades on the daily time frame. If your entry signals are not simple to identify, you might want to consider changing it. It should be clear and easy to identify within a few seconds whether a signal is present or not. Next, we can look at our stop loss. These are a must for every trader because it protects you from incurring huge losses should your trade turn against you. Enter a trade knowing what the worst case scenario may be so that you are prepared for the outcome. Although stops protect us, remember that we can get stopped out beyond where the stops are placed if the market opens beyond the stop, which occurs from time to time in the stock market. Even if this does happen, the losses should not be too detrimental to your account if you are risking a small percentage of your account in the first place. When placing stops, they must be at a good distance from price to allow for enough room to move in case there are deep pullbacks. We don't want to get stopped out prematurely only to see the trend resume. Stops should not be placed too far from the market either. We don't want to still be in a trade when the market is reversing. No stop placement is going to be perfect, but choose a method which is effective most of the time. If you find yourself getting stopped out too early most of the time, then your stop is too close. And if you find yourself getting out too late, then consider positioning your stops closer. There are many different methods for managing stops, but you just need to choose one. Some simple stops to use can be based on moving averages, such as the 100 simple moving average. Some may find that to be too far from the market, so the chosen setting should be suited to the trader and their style of trading. Earlier, I mentioned how we can reduce the amount we can lose in a worst case scenario, such as price gapping beyond our stop. And we can do this by setting our initial risk to a low percentage of our account. We set our trades with a maximum risk of 2%. This protects us from wiping out our accounts like many do when starting out. Drawdowns do happen from time to time, so to protect your account further, it is a good idea to stop trading if your account goes down by a predetermined percentage. For example, you can include in your trading plan that you want to stop trading if your account drops by 25%. If that amount is too high, then you can lower it. The idea is to stop trading so you can review your strategy and make some tweaks if needed. Having an idea of entering and exiting trades as well as managing risk, you will have the essential basics for creating a solid trading plan.